Most beginners think investing is something complicated, risky, and reserved for people with a lot of money. They picture flashing screens, traders shouting, and complicated charts. But at its core, investing is one of the simplest financial ideas in the world. You put your money in something that has a chance to grow, and you give it time to work. The complexity is not in the idea. The complexity is in the noise around it. At its core, investing is the act of using your money to own something that can grow in value or pay you over time. That something can be a share in a company, a piece of real estate, a bond, or a fund that holds many of these at once. You are no longer just storing money. You are owning small pieces of productive things that have the chance to become more valuable. This matters because cash alone usually does not grow fast enough to keep up with inflation. If you only save, your money may slowly lose buying power over decades. Investing gives you a chance to grow your money faster than prices rise. It does not guarantee anything. But over long periods, well-chosen investments have historically outpaced inflation by a meaningful margin and built real wealth. To understand how it really works, think of the simple idea of ownership. When you buy a share of a company, you own a tiny part of that business. If the business grows, your tiny part grows with it. If the business pays profits to its owners, you get a small share of those profits. The growth and the income, taken together, are how the value of your investment can rise. Let us look at a simple example. Imagine you invest $100 in a broad fund that tracks many companies at once. If those companies grow over time, the value of your fund grows. You did not pick any single winner or loser. You quietly benefited from the overall growth of the group. That is the core idea behind low-cost diversified investing. Many small pieces, working together, smoothing out the bumps. A common beginner mistake is thinking investing means picking the next hot stock. People hear stories about someone who got rich on a single big bet. They try to copy this and often lose. Picking individual winners is hard, even for professionals. Broad, diversified investing is less exciting and far more reliable. Wealth is usually built quietly, over decades, not in dramatic single trades. There is also a hidden risk in trying to time the market. People often wait for the perfect moment to buy, expecting prices to drop. They wait, and while they wait, the market often keeps moving. By the time it feels safe, prices may be higher than when they first thought about investing. Time in the market has historically mattered far more than timing the market. A useful way to picture investing is as planting a forest. You do not plant a single tree and obsessively watch one branch. You plant many trees and let them grow. Some grow slowly, some grow faster, a few might fail, but the forest as a whole keeps expanding. Long-term investing works the same way. Many small ownerships, given enough seasons, become a powerful collective asset. A second key idea is risk and time horizon. Investments that grow faster tend to move up and down more sharply along the way. If you need your money in 2 years, those swings are risky. If you have 20 years, the same swings become less dramatic across that long stretch. Matching the type of investment to how long you can leave it alone is one of the most important skills. A practical example helps. Imagine someone investing money they will need in 6 months for rent. A volatile investment is a poor choice, because a sudden dip could wipe out their plan. Now imagine someone investing money for retirement decades away. Short-term dips matter much less, because they have time to recover. The same investment is right for one person and wrong for another, based on time. Beginners often misunderstand the role of fees. Small percentage fees on investments look harmless. But fees compound just like returns do. A high-fee fund and a low-fee fund holding similar investments can produce very different long-term results. Over decades, fees can quietly eat a meaningful slice of your potential wealth. Paying attention to the cost of investing is just as important as paying attention to the returns. There is also a psychology angle. Markets test patience. They rise quietly for years, then suddenly drop. Most people panic and sell at the worst possible time. Then prices recover, and the same people buy back in once everything looks safe again. They have effectively sold low and bought high. The biggest enemy of long-term investors is rarely the market itself. It is their own emotions in difficult moments. A simple practical rule helps you start with confidence. Invest a small, consistent amount on a regular schedule, no matter what the market is doing. This is sometimes called regular investing or steady contributing. It removes the need to predict prices. Over many months and years, your average purchase price smooths out, and you stop trying to outguess the markets. Consistency does the heavy lifting. There are things to avoid as a beginner. Do not invest money you will need soon. Do not chase the latest trend or hot tip. Do not borrow money to invest in volatile assets. Do not check your portfolio obsessively, because frequent checking encourages emotional decisions. And do not invest in anything you cannot explain in 1 or 2 simple sentences. If it is too complicated to describe, it is too risky for now. A better habit is to keep investing boring on purpose. Choose simple, broad, low-cost options. Automate contributions every month. Review your strategy once or twice a year, not every day. Stay invested through ups and downs. Boring is not a weakness in investing. It is often the secret weapon. Excitement is what financial entertainment offers. Long-term wealth is what calm, consistent investors usually keep. Over the long term, even modest investing habits can produce surprising outcomes. Someone who consistently invests a small percentage of their income from a young age into broad and reasonable investments can build a significant portfolio over a working life. They are not lucky. They did not pick the right stock. They simply respected time, kept costs low, and refused to panic. That alone places them ahead of most people. So here is the short version. Investing is owning small pieces of productive assets and giving them time to grow. The basic ingredients are broad diversification, low costs, regular contributions, and patience. Risk and time horizon should match. Fees and emotions are the biggest hidden enemies. The market will move. Your behavior is what decides whether those movements help you or hurt you over the years. If you want to be a long-term investor, you do not need to be smart, lucky, or rich. You need to start small, stay consistent, keep costs low, and resist the urge to react to every headline. Time, more than talent, is what builds wealth in the markets. Once you respect that, investing becomes one of the quietest, most reliable financial tools you have, working for you in the background of life.